Hey, what's up, guys? It's Jonathan here. So, tomorrow is a huge day. We have one of the most important CPI reports of the year being released. And this is very critical to what we'll hear from the FOMC in their meeting this week and how dovish or hawkish they'll be at their meeting. And this will also be important just to the overall sentiment of the market. So in this video, I'll discuss the expectations for CPI, what to look out for, my expectations of how the market will react to CPI news. So let's get into it. The expectation for November CPI numbers is 0.3% month over month. If you annualize that, that comes out to about 3.6%. That's both for the core and non-core numbers. And then year over year, we're expecting a number of 3.7% on the non-core side, and then 6.1% on the core side. And both those numbers are lower than what we got during the October results. So if we end up getting the expectations that the market is expecting that we'll get, we'll have further evidence that inflation has peaked and that it is starting to trend downwards. And this will probably cause the Fed to start to slow down or stop their rate hikes in the near future. So some of the things that we should look out for, the first thing is the used car inflation. So last CPI report, we did see used car prices start to tick to the downside. And I remember I did make a video about this earlier, like a couple weeks ago, talking about how we're starting to see the used car market slow down, mostly due to the fact that we are seeing higher rates for used car financing. And also we're getting, which is causing an increase in supply. And that's probably some of the reason why we are getting that downwards pressure. Another sector that we should look at is shelter. And this sector is a bit of a wild card. So we have seen mortgage rates start to tick down recently, mostly because the market is anticipating that the Fed will have to stop hiking rates soon, or they may even start to lower rates a lot sooner than what the market originally expected. So that is leading to a lot of bond buying now, and because of that, that's causing yields to fall, which also includes mortgage rates to fall as well. So that does lead to less pressure on home prices. But I don't think we're necessarily going to see that in the CPI results that we get this month, just because usually that effect lags a couple months. Just because, think about it, if interest rates change today, the people who are buying homes today are buying homes today with like October rates. So it's going to take much longer time to actually see any kind of effect to the housing market because of the recent softening in mortgage rates that we had. Rents are actually going to be the big player when it comes to shelter inflation. And we have seen rents start to slow down from what we saw in the October CPI report. But some suits do believe that because of the size of the pullback that we got in the October report, that we may see a reversal in this November report. So like I said, that's the reason why I think it may be a wild card. And also another thing you gotta remember is that shelter makes up about over 30% of the CPI reading. So shelter inflation plays a really big role in inflation overall. And one of the concerns right now is that if we don't see shelter inflation either stabilize or start to soften a bit, this may mean that the Fed may step on the gas to continue hiking rates just to get shelter inflation down. So it'll be important not only to pay attention to shelter for this report, but also to pay attention to it in future reports as well. So some of the smaller categories that we should look out for, they won't play a big role, but another sector we should watch out for is gas. As we have started to see gas prices slide since early November, with WI crude down to December 2021 lows. And because of this, we may even see a negative reading on gas for the year over year number. And that'll be the first time that we've had that since 2020. So something else we should look out for is core good prices. So when you think about core, that's food and energy, and then core good prices. So really we're talking about the price of like groceries, of gasoline, electricity. Economists are expecting to see a continued drop in these prices, mostly due to improved supply chains and less demand, and as well as I said earlier, oil, as well as what I said earlier about gasoline. One thing about gas that makes it very unique from every other inflation sector is the fact that gasoline affects every other sector of the market. Because think about it, if you want to go and buy groceries, well, those I don't know, let's say you want to buy bread. Well, the bread has to be the wheat has to be picked, and the wheat's usually picked by a machine that uses oil. Then it has to be delivered to the grocery store, and that's usually done in a truck that's run by oil. Then the grocery store has to keep the grocery store temperatures at a appropriate level, and that's done by energy. So energy inflation tends to really get enrooted in a lot of other inflation numbers that we get. So as we do start to see energy prices come down, especially gas prices, we will probably see more softening in with core goods like food as well. We are starting to get less demand with some of these products as well, because you have people, maybe instead of buying steak, now they're buying ground beef, and they're kind of adjusting their spending to inflation. So for expectations, if we get under a 0.3% month over month reading, I think that we'll have a strong green market on Tuesday. And because this will be a good sign that we are starting to see inflation trend down. Whereas if we get a reading anywhere between 0.3 and 0.4, we may see a market that's still slightly green, but it does show that inflation is just stabilizing. It's not actually trending down. So it's kind of good that we're not seeing it go up, but it's also not good that we're not seeing it go down either. I don't think it'll necessarily play a huge role like in the long-term thinking, just because flat is still good, even though it's not as good as seeing it go down. Now, if we get anything above a 0.4% month-over-month reading, I think we'll have a really bad red day, as this shows that the Fed needs to do more hiking, and they need to be more aggressive about getting inflation down. And when it comes to FOMC meeting, the 50 basis point hike is pretty much like a done deal at this point. I think that the CPI report will mostly dictate how dovish or hawkish Jay Powell is during the FOMC press conference. And that will really, and what he says has more effect on the market than the actual hike or the amount of hike that we get on Wednesday. Who knows, if we do get some crazy reading like 0.6 or 0.7, they might come out and they might say, hey, another 75 basis point hike. But I think really with the Federal Reserve, they're really going to have to dig through the devils of the detail of this report. We did get the PPI report on Friday, and that was a bit of a mixed report. So it's not as easy as just looking at the headline number and being like, yep, 75 basis point hike. It's a little bit more tricky than that. But anyways, thank you guys so much for watching. As always, please like, share, and subscribe, and I'll see you in the next video. Peace.